Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
If we push it over here to take a look at equity options, something, of course, that also trades at the ICE and that many of you are familiar with, we had, over the last few weeks, in fact, done an Invest Like a Monster seminar where we went in and one of the guys from the ISE, Mark Absey, came out to Chicago, and we had some 280 people come to this full-day presentation on options, how they could use them, whether it's for ETFs or whether it's for FX options or index options, equity options. And we talked exactly about how do you take advantage of situations like IBM. When we did that, IBM was actually over here on this end of the graph. IBM was just over 70 when we did this example during that time. And as you see, as of yesterday or the day before, IBM was $83. So a $12 rally out of IBM in a month. Definitely that volatility paying off for you if you're able to take in the big premium and then ride out some of the wild moves the market gives you because you were shrewd enough to take in that big premium. Taking a look at this, with IBM trading at 83.50, for instance, we could get in here and do a trade, a covered right. You can see where that red arrow is on the screen. If we buy IBM at 83.50, and by the way, after a $2 plus sell-off today, IBM's still 82.69 on the close. But as you can see from the screen here, if IBM's at 83.50, and we get in here and buy it and sell the January 85 calls, they're just $1.50 out of the money. We're collecting $5.30. You can see on the screen there, the bid at that second was $5.10, $5.40, and we collected $5.30 for those calls, and then stock rolled over just a little bit. Again, to show you how we can do it with showing you the net as well. If you buy that 1,000 shares of IBM and sell those calls, your net out of pocket is approximately $78.19. Again, that's going to move dynamically the difference between the stock that you've purchased and the calls that you've sold, and that is going to populate that ticket exactly with those streaming quotes from the Trade Monster site. So if we sold 10 of those January 85 calls for $5.30 against that 83.50 investment, we've got approximately $78 in the trade. Again, 83 minus 5. If you looked at that and said, okay, if IBM rallies to 85, it's a $1.50 rally. The Jan 85 calls at January expiration would be worthless. So our profit would be the $5.30 because those calls, we sold them, that's our premium to keep regardless of where the stock goes, plus the movement in the stock. It was beneath 85 when we sold them, so we get the movement of the stock up until 85, and then, of course, our stock could be called away. But that's $6.80 on that $78 investment, or about 8% in just those 40 days. If you look, of course, and say, well, what happens if the stock keeps going north? Again, the reason that your broker doesn't make you put up any additional margin to do this trade is that you have no upside risk. If the stock goes to 90, the stock will have, it says declined, I apologize. The stock will have gained, not declined. It's all here all. The stock will have gained $6.50 our Jan 85 calls would be worth $5. So we are at the exact same price, exact same profit, $6.50, with the stock running up to 90 as we were with the stock at 85. Once the stock or FX option, index option, whatever it is, once it gets to the strike price that you've sold, that's as good as it gets. You don't do any better. It does protect you down to 78, but it doesn't give you any additional on the way up. You don't make any additional money there. So let me see. So I'm just going to make one little quick thing here. As you might imagine, whoops, let's see. This diagram would look something like you have a flat line once you get to the strike price, which in this case was 85, and you go like that to the downside because, of course, as the stock moves to the upside, you participate up until you get to the strike price that you've sold, in this case 85, and to the downside, you shield yourself against loss until you get to that $78 level right here. And at that point, you no longer have protection. Now you just lose because your stock is going to continue. If it continues to go lower, your stock has no additional premium to suck out of those options. So if you were to collect $5.30 every 40 days or every month against your $83,000 investment, you would generate almost $64,000 from covered writing alone, which would be a 76% return. Now, as either Mark Absey or any of the folks that you would go out and listen to would tell you, this particular situation hasn't existed for very long, and in fact, this is the longest it has existed in this way since I've been a trader, and that's been for the past 28 years. The fact that we've got a situation where you're getting rewarded for taking risk because volatility has remained so high means you can generate extraordinary returns like this from the sale of these very pumped up options. Again, if we pulled back a couple slides to this one, those options that we were selling, those just out of the money options for $5.30, those options at a normal volatility for IBM would probably be something like $4 or $3.70, not $5.30. And if you took that and multiplied it by the number of, by 12 instead of the $5.30 by 12, you'd be at a significantly different rate of return. I mean, 370 times 12 means instead of $67,000 a year in overwrites, you'd instead have about $44,000 in overwrites against that $83,000 investment. So it'd be significantly lower return. Still a very attractive return, I would argue, but not at all at the level that it's at right now, because these are outsized premiums that we're harvesting right here. If you go forward to this next one, this is U.S. steel, and this is just like our British pound example. This is selling puts for dollars. And if we look at that graph, there's U.S. steel. I'll note for you that, again, when we did that conference in November, that U.S. steel had gotten all the way down to $20 a share. And as of yesterday was $35.02. Let me just get a reading on where it finished out today. Finished at down 81 cents today. So still right at approximately 35. It closed out at 34.98 today.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.